What I'm going to recommend to you as far as a passive investment is to invest in what's called an index fund. Index funds give you the added benefit of diversification without the active management fees. In fact, in most cases, these index funds outperform the actively managed mutual funds. So the guy that you're paying to manage your money is not even able to beat market returns in most cases. So what exactly are you paying them for with those management fees and those transaction fees? Every time that they restructure the portfolio and change around the investments, you're paying some kind of fee for that. And if they're not even able to beat what the market pays, why are you doing that? What is the benefit of having active money management? That's the big question. Rather than paying someone to actively manage your money and rack up those investing costs, just invest in an index fund, which gives you broad exposure to the market. So index funds hold investments, which results in fewer or no trading costs. When you invest in a mutual fund and they're actively trading investments and restructuring it, you're paying trading costs every time you do that. Now, if you decide to invest in individual stocks and you trade stocks through a stockbroker, you're going to be paying transaction costs every time you buy a stock and sell a stock. Now, this may not seem like a lot of money, but for active traders, this adds up to a lot of money being wasted just in transaction costs. Index funds are also more tax efficient. Every time investments are sold within a mutual fund, you have to pay a capital gains tax on that. But when investments are not being sold, there's actually less of a tax drag on that, so you get a better return on your investment over time. So that's just one of many benefits of index funds over mutual funds. As far as which index fund is the best, I highly recommend Vanguard index funds. The average Vanguard index fund expense ratio is 71% less than the industry average. And the lower the expense ratio is, the more money stays in your pocket and the more money is being reinvested. I know this may not sound like a lot of money, but if you look up the cost of mutual funds with just 1 or 2% expense ratios, over 30 or 40 years, we're talking hundreds of thousands of dollars or more that you've lost in expense ratios. This is largely due to compound interest, something that you want to take advantage of as an investor. So just understand that even though it sounds like a small amount of money, we're talking hundreds of thousands of dollars in long-term investments being lost with high expense ratios. As far as which index funds to invest in, I'm going to give you guys 6 recommendations here. If you want to learn more about these, I'm going to give you the symbol of them. Just type them into Google. It will bring you right to the Vanguard page and you can learn more about them. I just want to state to you guys that I am in no way being paid by Vanguard to offer these. I simply want to give you guys the best advice possible and give you my best recommendation. These are the funds that I recommend to anyone, and I am in no way getting any kind of kickback by recommending these to you guys. Number 1 is VTI, which is the Vanguard Total Stock Market ETF. This basically gives you exposure to the total United States stock market. Number 2 is VXUS, which is the Vanguard Total International Stock Market ETF. This gives you exposure to all non-United States stocks. So this is exposure to global stocks outside of the US. Number 3 is VT, which is Vanguard Total World Stock ETF, which gives you exposure to not only the United States stocks, but the stocks in the rest of the globe as well. The VT Vanguard Total World Stock ETF gives you the most diversification and the broadest exposure possible. An ETF is an exchange-traded fund. What this means is that exchange-traded funds trade on a secondary market through a stockbroker. So in order to invest in an ETF, you would need to have a trading account of some kind. You would have to go through a secondary market through a stockbroker and buy these funds on an exchange. So in order to do that, you would have to open up a trading account and do this online yourself, or call up a stockbroker who could do this for you. There is an easier way to do this, and this is called Admiral Shares through Vanguard. When you invest through Admiral Shares, you don't have to do this through a secondary market through a stockbroker. So my 4th recommendation would be the VTSAX, which is the Vanguard Total Stock Market Admiral Shares. This gives you exposure to the total US stock market through Admiral Shares. I'll explain what that is in a second. And then we have VTIAX, which gives you exposure to Vanguard Total International Stock Market, which is going to be everything outside of the US, and this is also Admiral Shares. Now, Admiral Shares are a special class of Vanguard index funds with a lower expense ratio as a result of larger accounts. So basically, because there's a larger amount of money under management, they can charge a significantly lower expense ratio. The only thing with this is there is a higher minimum account balance, so there is a higher minimum balance to open up one of these accounts with Admiral shares. But the benefit of this is you don't have to go through a secondary market or through a stockbroker. You can just go on Vanguard.com and invest directly in this. Now, if you're looking to have exposure to all global markets, not just international or just US, there is the VTWSX, which is the Vanguard Total World Stock, but this is investor shares. So this is a slightly higher expense ratio than those Admiral shares. They don't have a Vanguard Total World Stock Admiral shares plan available yet. So it's not a ton of money. It's still a very low expense ratio, but it is slightly higher than those Admiral shares.